Hi everyone, Piers Bolger here, the Chief Investment Officer at Viridian. Well, continuing on with our current market updates, we've seen market volatility and the dislocation in markets continue through the early part of this week, particularly when we look at what's occurring in offshore markets. The US market has been sold down relatively heavily over the last couple of days, and from our perspective, as the economy starts to feel the impact of the coronavirus and the shutdowns that we're seeing in the US, as well as obviously in Europe and other parts of the world, that is clearly having a meaningful impact on investor confidence and the sentiment going forward. When we try and just gauge a little bit in terms of what's the response been, and certainly from a central bank point of view, we're seeing central banks really now become a lot more coordinated in their approach. The US Fed has continued to reiterate providing support to the market. It announced, obviously, further cuts in interest rates on Sunday US time, Monday morning our time, as well as additional economic packages in terms of, basically QE in regards to providing additional stimulus into the market and liquidity into the market, which remains the most important part of ensuring that markets can function in a stable manner. The US Fed Chairman Jerome Powell made comment to exactly that nature, that they wanted to ensure that treasury markets remained liquid, that they wanted to ensure that the funding side of it remained stable, even in what continues to be a very challenging macro environment. We saw the ECB, the Bank of Japan, also follow suit. So at least at a central bank level, we are clearly seeing signs, as I said, of that support continuing to come through. Really important in terms of overall market confidence once we get through, obviously, the challenges that we're facing at the moment. Locally, the RBA, in our view, will make an announcement in the latter part of this week. We do expect another cut in official interest rates, and we also expect that the RBA will start to begin purchasing of Treasury securities. So quantitative easing in the Australian context, we do expect, again, the RBA will pushing as far as can go in regards to interest rates. We don't expect negative interest rates either here or in the US, but as I said, they'll be looking at all tools and mechanisms in order to provide liquidity, in order to provide, as I said, ensuring that markets can function in a stable manner. At a political level, in terms of things, we would say that the US is now starting to catch up to the realities that it's facing, and we expect more to be done. Clearly, obviously, countries are going into lockdown at a greater pace, but in our view, this is the most logical way to deal into it, because if they can contain the spread of the virus, if we can get to peak infection rates quickly, as quickly as possible, that will enable economies, the impact on economies we think will be less, and will enable those economies as we head through the second part of the year to benefit from, what is going to be a very, very extensive fiscal and monetary response in order to maintain economic activity. So as we sit here today, clearly markets are remaining very, very challenged. We expect volatility to be high. It's the highest it's actually reached, as I said, since 2008. We don't expect that to dissipate anytime soon. Clearly, that does cause concern for investors and increase worry when they see markets continuing to move lower. But again, from our perspective, it's about holding the line. It's about understanding the market that we're currently in. We are seeing, as I said, some more attractive opportunities open up every day. We're thinking about how to position that accordingly. We are clearly now seeing a more coordinated, both fiscal, political, as well as monetary response from central banks. So it doesn't mean the challenges that we're facing are going to go away anytime soon, but we are, as I said, starting to see what I'd say is a better response from both governments as well as from monetary authorities. As always, please feel free to reach out to any one of your advisors. We'll continue our market updates as this evolves, and we look forward to catching up again soon. Bye for now.